In the world of investing, dividends are like gold dust. They're a share of a company's profits, paid out to its shareholders, and they can be a powerful tool in your investment arsenal. Not only do they provide a steady stream of income, but they also offer potential for growth. Key to understanding dividends are two concepts: dividend yield and dividend growth rate. These two factors play a crucial role in determining the attractiveness of a dividend investment. So, are you ready to uncover the secrets of dividends? First off, let's delve into dividend yield, the sexy, high-profile star of the dividend world. Dividend yield is a financial ratio that shows how much a company returns to its shareholders in the form of dividends. It's calculated by dividing the annual dividends per share by the market price per share. The result is expressed as a percentage, and it's a great way to compare the dividend returns of different companies. Now, why is dividend yield important? It gives investors a snapshot of an investment's income-generating potential relative to its price. In other words, it's a measure of bang for your buck. A higher dividend yield means a greater return on investment, at least on paper. This makes it a very attractive metric for income-focused investors. But here's the kicker. While a high dividend yield can certainly be appealing, it's not always a sign of a good investment. Why? Because companies with high yields can sometimes be in financial trouble. They might be paying out more in dividends than they can afford, which could lead to a dividend cut down the line. Or, the high yield might be a result of a falling share price, which could indicate underlying issues at the company. So, while dividend yield can be a useful tool in your investing arsenal, it's crucial to look beyond this single metric. It's like judging a book by its cover. Yes, the cover can give you some clues about the story, but it doesn't tell you everything. That's why smart investors also consider other factors, like the company's earnings growth, its payout ratio, and the stability of its dividends, among others. In short, dividend yield is a useful but imperfect tool. It can point you towards potentially profitable investments, but it's not a guarantee of success. It's a starting point, not the end goal. Remember, a high yield is attractive, but it's just one piece of the puzzle. Now let's shift our focus to the often overlooked yet powerful dividend growth rate. Dividend growth rate, as the name suggests, is the annualized percentage increase in a company's dividend payment over a period of time. Think of it as the annual speed at which your dividend income grows. It's like watching your money tree sprout new branches every year, each branch representing an increase in your dividend income. How do we calculate it? The simplest way is to take the dividend payment of the current year, divide it by the dividend payment of the previous year, and subtract 1. This gives us the growth rate for that particular year. However, the more accurate way to determine the average annual growth rate is to use the compound annual growth rate, or CAGR formula. It's a bit more complex, but it provides a smoother and more realistic growth trajectory. Now, why is this so important? Well, a company with a history of steady or increasing dividend growth indicates strong financial health and confidence in future earnings. It's a positive signal to investors that the company is growing and is committed to sharing its profits. But here's the real magic. Over time, a steady or increasing growth rate can potentially yield you more returns than a high dividend yield. Yes, you heard that right. This is because the power of compounding steps in, and your dividends start earning dividends. It's like a snowball rolling down a hill, gathering more snow and becoming larger as it descends. Remember, dividend investing is a long play type of investment. It's not about buying today and selling tomorrow. It's about patience and consistency. It's about letting your investments grow and reap the benefits over time. So if you're in it for the long haul, don't just chase after high yields. Look beyond the numbers. Pay attention to the dividend growth rate. It's a key indicator of a company's potential for long-term growth and stability. So, never underestimate the power of a steady or increasing growth rate. It could be your ticket to long-term wealth. Now that we've got a handle on both dividend yield and dividend growth rate, it's time to talk about balancing the two. Think of it as a seesaw. On one end, we've got dividend yield, the income you receive from your investment. It's tempting to prioritize this, as it's immediate, tangible, and provides a nice cushion, especially in volatile markets. But concentrating solely on yield could be a risky play. High yields can sometimes indicate a struggling company, potentially leading to cut dividends, or even worse, a falling stock price. On the other end of the seesaw, we've got dividend growth rate. This is the rate at which the dividend payments increase over time. It's less immediate, less tangible, but oh so important for long-term investors. Ignoring growth rate could mean missing out on potential long-term gains. A company with a low yield but a high growth rate could end up paying a substantial income over time. In fact, a rising dividend can also indicate a healthy growing company. This balancing act between yield and growth rate is crucial. It's not about choosing one over the other, but understanding how they can work together. It's about finding a sweet spot where you're comfortable with the immediate income and confident in the future growth. So remember, it's all about balance, yield and growth rate. They're two sides of the same coin. So we've taken a deep dive into the world of dividends. We've explored the powerful allure of dividend yield, a percentage that shows how much a company returns to its shareholders. It's a tempting figure, isn't it? But we've also learned that it's not always the most important factor. We've also journeyed into the often underestimated realm of dividend growth rate. This is the pace at which these dividends grow, and it can be a game changer. A company with a high growth rate could potentially be a better investment, even if its yield appears less attractive at first glance. The key, as we've discovered, lies in the balancing act. These two elements, yield and growth rate, must be weighed against each other in your investment strategy. Remember, dividends are the slow and steady path to wealth. And with the right balance of yield and growth, that path could lead straight to your financial goals.